Have you ever wondered how some of the world's wealthiest individuals manage to pay surprisingly low taxes? It's a world where financial insight meets legal prowess, and few have navigated this space as notably as former US President Donald Trump. But how does he do it? Is it sheer brilliance, a loophole in the system, or something else entirely? Let's dive into this intriguing world of evading taxes legally. Donald Trump's handling of taxes goes beyond simply minimizing his dues. It demonstrates a skillful manipulation of legal frameworks to work in his favor. Reports, including a detailed one from the New York Times, reveal a pattern of legal tax minimization strategies. For instance, Trump paid just $750 in federal income tax in both 2016 and 2017. His strategy? In the realm of Donald Trump's tax strategies, business losses play a pivotal role. Trump's businesses, particularly in real estate, often report significant losses. These aren't just setbacks, but strategic tools in tax planning. Another name for this technique is the use of net operating losses. NOLs arise when a business's deductible expenses surpass its income, creating a loss for tax purposes. These losses can be strategically leveraged through carryforwards and carrybacks. Carryforwards allow businesses to apply losses to future tax years, reducing taxable income and, consequently, tax liability. This method is especially useful in industries like real estate, where payment can fluctuate significantly. On the other hand, carrybacks enable businesses to apply losses to previous tax years, potentially leading to tax refunds. Trump's tax records show he extensively utilized NOLs, particularly carryforwards, to offset taxable income in profitable years, thereby reducing his overall tax burden. This practice, while legal and common in business, has sparked debate about the fairness of the tax system, especially in comparison to the tax responsibilities of average citizens. Trump's use of NOLs underscores the complexity of U.S. tax laws and the ways savvy individuals and businesses can legally minimize taxes. In the complex financial strategies adopted by Donald Trump, consulting fees, particularly those involving family members, have been a subject of interest and scrutiny. These fees, often paid to family members for their roles or contributions, are a common practice in family businesses, but can become problematic when entangled with public figures like Trump. For instance, Trump's financial disclosures revealed that he received consulting fees from the Trump Organization while serving as president. This raised ethical concerns, as it blurred the lines between his presidential duties and personal business interests. The consulting fees, totaling $61,045 in 2018, were paid through an entity linked to Trump Organization projects. This payment was unique, as it was the only one of its kind reported since Trump became president. Moreover, Ivanka Trump's involvement in these consulting arrangements has also been a point of discussion. She received income from a consulting company while also being an employee of the Trump Organization. This dual role led to questions about the nature of the consulting work and whether these payments were legitimate business expenses or a means to reduce the company's tax burden. The use of consulting fees in this manner can be a strategic move in financial planning. If these fees are for genuine consulting work and are at fair market rates, they can be deducted as business expenses, thereby reducing taxable income. However, the ambiguity surrounding these payments, especially in high-profile cases like Trump's, stresses the need for transparency and proper documentation in financial dealings. Loan liabilities serve as a crucial tool for legal tax minimization, and in Donald Trump's case, they are even more pronounced. The approach is pretty much like walking a tightrope, balancing between legal tax reduction tactics and the complexities of large financial obligations. Trump's method involves leveraging loans to reduce taxable income. This is what actually happens. When a business, like Trump's real estate ventures, takes on a loan, the interest paid on that loan can often be deducted from its taxable income. This means that the more interest the business pays, the less income it has to pay taxes on. It's a common strategy used by firms to lower their tax bills legally. For Trump, this approach has been particularly effective due to the size of his loans. His high-profile real estate projects often require substantial financing, leading to significant interest payments. These payments then act as a shield against taxes, reducing the amount of profit that is subject to taxation. However, this strategy has its risks. Large loans mean large debts, and these debts must be managed carefully to avoid financial strain. For Trump, the challenge has been to balance the benefits of tax reduction with the responsibilities of debt management. The off-year C corporation strategy is another clever method used in tax planning, and it's something that smart business people like Donald Trump might employ. This strategy revolves around the timing of income and expenses to minimize tax liabilities. In a typical C corporation, the fiscal year aligns with the calendar year, ending on December 31st. However, an off-year C corporation doesn't follow this pattern. Instead, it ends its fiscal year at a different time, say in July. This shift allows the corporation to defer income and accelerate expenses. Here's how it works. By ending the fiscal year in an off month, the corporation can push income into the next fiscal year. This means that income earned late in the calendar year is taxed in the next fiscal year. It's like delaying the moment when you have to open your wallet to pay taxes. At the same time, the corporation can bring forward expenses, deducting them in the current fiscal year. This reduces the taxable income for that year. For someone like Trump, with multiple business ventures, this strategy can be particularly effective. It allows for more flexibility in managing income and expenses across different entities, leading to potential tax savings. However, it requires careful planning and a deep understanding of tax laws to implement effectively. The success of The Apprentice TV show brought Trump significant income, leading to substantial taxes in the following years. However, he managed to get most of that back through a $72.9 million federal tax refund. This refund, still under review, highlights the complexity and effectiveness of his tax strategies. While Trump's tax strategies have certainly raised eyebrows, it's crucial to understand that tax avoidance, which involves using legal means to minimize taxes, differs from tax evasion, an illegal act. Trump's tactics, though controversial, fall under legal tax avoidance, a practice used by many wealthy individuals. For the commoners, though, exploring Donald Trump's tax strategies is like uncovering a treasure map of smart tax moves, from using business losses to clever loan tactics. It shows how knowing the rules can lead to big savings, making Trump's approach a fascinating lesson in navigating the tax world.